Hi! Today we are going to break down a topic that many people consider secret, but in reality it's just an understanding of price movement. This is liquidity zones and stop hunting. If you ever noticed that you entered a trade in the right direction, but price first hit your stop loss and only then moved where you expected, that means you encountered a liquidity zone. Most beginners think the market is against them, but in reality the market goes to where other people's stop losses are. That is liquidity. In this video, I'll explain the process of how market makers look for liquidity, why price pauses before a move, how to find these areas in advance, and how to use them for entries. I'll show everything in a kind of quick trading mode. First, I want to focus on what liquidity is in simple terms. Liquidity is areas on the chart where a lot of orders are located. Pending orders, market orders, and price moves to where these orders can be collected. Why does a market maker collect stops, and who is a market maker? A market maker is a large player who provides price movement. To move the price, they need volume. And where does that volume come from? From where beginners' stop losses are placed. The logic is simple. First, the market goes to where the stops are, collects liquidity, and only then moves in the real direction. Experienced traders understand this and can see it on the chart. And you also need to learn how to identify these liquidity zones. Liquidity zone almost always form above resistance levels. For example, you see resistance, price reaches a peak, then a small correction begins, followed by a sharp drop. This is again a false breakout. The upward trend is obvious. I think price will at least return to this zone and then continue upward. Here we have a resistance level. This is where buyers' stop losses are located. At local highs and lows, just like in textbooks, stops are placed beyond trend lines. The market maker knows that the crowd places stops this way. As a result, a fake breakout forms. Price sharply moves beyond the level and then immediately returns. Now there's a correction, and again price will approach these levels. This is a false breakout because price did not continue further. It's not the trend direction. This is important to understand. If you understand these things, you can identify the strongest entry points for yourself. There are three types of liquidity. Liquidity above and below levels. The most obvious one is where the crowd stops are. Here's a resistance, here's support. When price is in a range, everyone places stops beyond the range boundaries. It's important to understand how the chart behaves. When a candle is large, people chase a move but place tight stop losses. The market maker takes them out to continue the move. How to use liquidity zones for trading? First, you need to find support and resistance level. Let's look at an example on this currency pair. We choose a 1 minute time frame. If you are trading the 1 minute chart, you analyze it in detail. Of course, the hourly time frame shows the overall trend, while the minute time frame shows impulses more clearly, while still maintaining the overall structure. We draw a horizontal line. We mark our high, the resistance level, the support level, in this case, you simply wait for an impulse beyond the level. This is called stop hunting. Then you wait for price to return back and enter in the direction of the reversal. Here, price reached the level and now it's moving down. I'll try to open an order on another pair, but you need to understand that liquidity testing is not a fast process. In general, rushing is the enemy of trading. I'll never get tired of repeating that. You must always keep a cool head and not act randomly. This is why in my videos I don't overload you with too much detailed information, but instead explain things in a more general way, because we will return to all these concepts many times in future videos. Again, liquidity zones, mark them, identify support and resistance levels first. This is the zone where most stops are located. Experienced players press buy and the market reverses and moves in their direction. This is an important point. Price will break further. That's obvious. When many traders get stopped out here, big players are only just beginning to enter the market, and price moves due to their actions. They wait for the right moment. They understand psychology. This is more about analyzing player behavior. Again, a false breakout. Price sharply moves beyond the level and immediately returns. An experienced trader understands this and doesn't follow the move. He knows price will come back and waits to enter later. This is why many traders see a staircase, like move downward and would enter short here, but the market reverses upward. This is another type of false breakout. Again, a long candle wick touch stops and closes back inside. As you can see, the profit here is quite decent. Once again, we've identified the impulse and the resistance zone. Standard analysis. Again, there are three types of liquidity. Liquidity above and below levels is the most obvious. The crowd stops. You simply mark support and resistance levels. Liquidity in consolidation zones, when price moves sideways and everyone hides their stops beyond the range boundaries. For example, price was in range for a long time. Here, it's obvious that stops are beyond the range edges. We wait for an impulse, price slightly moves beyond the range and then trends upward, leaving the consolidation zone. Liquidity on impulse is the same idea. When a candle is large, people chase the move but place short stops. The market maker understands this and takes them out to continue the move. In simple terms, price movement depends on their actions. This is a more strategic approach. What's important about liquidity zones? You find support and resistance, wait for an impulse beyond the level, like here. We marked resistance, saw a small impulse beyond the level, opened a buy trade and closed it almost here. Now we wait. Don't open trade after trade. Please don't do that. Even a few successful trades per day is already good. You wait for price to return and enter in the direction of the reversal. If it's a false breakdown downward, you enter long. If it's a false breakout upward, you enter short. This is liquidity testing. We will return to this concept many times. To conclude, liquidity zones are what move the market. The market is not chaotic. Everything you see on the chart is not random. Price goes where the crowd stops are. If you learn to understand this, to see levels, false breakouts, long wicks, and impulses beyond levels, you'll be entering where professionals enter. Finally, you must identify liquidity zones across different time frames. Always mark levels, understand the trend, and only the combination of all of this will give you consistent results and stable profits. I wish you successful trading. I hope you found this video useful. We will definitely return to liquidity zones in more detail. I wish you successful trading, and I'll see you in my next videos.